Good morning, good afternoon, wherever you are. This is Mark Sobel, U.S. Chair, IMF. Today, I have the great pleasure of being joined by Petya Koeva Brooks to discuss the IMF's latest World Economic Outlook. Petya is now Deputy Director in the IMF's Research Department, responsible for overseeing the WEO. She recently came to this position, replacing the equally wonderful Jean-Marie Melezi-Ferretti, from the IMF Strategy, Policy, and Review Department, where she served as Deputy Director in charge, among other things, of IMF conditionality and financing facilities. This is but the tip of the iceberg of her fund experiences, and I can tell all the listeners firsthand that Petya is one of the fund's most thoughtful and talented officials and finest individuals. Petya is going to start us off with a presentation on the fund's latest WEO. I'll follow up with some Q&A. This part of the conversation will be taped for the record. We'll then move to the audience questions, which can be submitted by the chat function. So Petya, the floor is yours. Thank you for joining us today.
Thank you very much, Mark, and thank you for having me here and for the kind introduction. And good morning and good afternoon to everyone who is online. Over the next 10-15 minutes, I'll just try to give you a flavor of our forecast and of the latest World Economic Outlook, which we rolled out just about 2 or 3 weeks ago. And as you can imagine, doing any type of forecasting in this environment is difficult to say the least. And one of the challenges is being also to just try to see through the high frequency developments and look at the overall patterns that are emerging in the global economy. So I'll start with that. Can I have the first slide, please? So the broad picture that we see is one of recovery this year. So what you see on the slide is the evolution of our forecast over the past year. A year ago, we started out forecasting a collapse of global output of minus 3.3, which is the largest decline in output in peacetime, and then projecting a gradual recovery afterwards. And from what you see from this slide is that in some ways our forecast, although it has evolved over this past year, it still preserves that pattern. And this year our forecast for growth is 6%, and we're expecting growth to moderate to 4.4. Now, compared to where we were just a few months ago at the start of the year in January, we do have an upgrade in that forecast from 5.5 to 6, and maybe it's important just to mention a couple of the reasons for that upgrade and for the kind of the improvement that we see. And one of them was that it was the fact that we'd been surprised over and over again by the fact that the relationship between the lockdowns and the activity that we've seen has really surprised on the upside. So back in the fall or in the towards the end of last year, when we were looking at the second wave coming and the lockdowns being put in, we thought that the impact of those lockdowns would be smaller than it had been in the previous wave, but still there. And instead, what we saw was a pattern across in the Q4 data and also in Q1 of this year of surprises, positive surprises across the board. And the second reason has, of course, been the very substantial fiscal support that had been provided since our previous forecast, in particular the U.S. package, the 1.9 trillion, which has really lifted growth not only in the U.S. but also globally, with countries such as Canada and Mexico benefiting the most. Now, Underpinning all of this is also the rollout of the vaccination campaigns, which has been proceeding at various speeds across economies. Now, the other part of the forecast and of the global outlook that we should not forget is the just incredible uncertainty that we faced last year. Now we moved from language about extreme uncertainty into tremendous uncertainty, and now we just say very high uncertainty. But whatever we call it is just to recognize that there are risks in both directions. There's still a lot that we don't know about the path of the virus, in spite of the progress that we've seen with vaccines. So can I have the following slide, please? Now, this is just to give you a sense of what is underpinning our current forecast. And I just mentioned vaccines. And here again, this assumption about uneven access to vaccine is quite important in terms of anchoring our forecast. What we're assuming is that this broad availability is going to be there in advanced economies and only in some emerging markets in the summer of this year. But then most other countries will have that availability only in the second half of 2022. And the vaccine deployment, this is assumed in our baseline, will be staggered across regions, with some countries exiting the crisis sooner and still having occasional lockdowns, which is something that we already seeing. The second pillar of our forecast is the assumption that we're still going to have supportive financial and conditions and more generally policy support. We have the US and Japan and others have announced sizable fiscal support for this year, for 2021. And in emerging and developing countries, the deficits the fiscal deficit that we've seen are generally expected to decline, but I would say narrowly. And when it comes to financial conditions, we expect those to remain broadly supportive for both advanced economies and emerging and developing economies. And the last part of the forecast is related to commodity prices. We expect strong growth in metal prices, and also oil prices. We expect it to grow by about 30% this year. Can I have the following slide, please? Now, the big theme of our forecast is one of divergences. So I started out with the overall numbers, but underneath those numbers, we just see tremendous variation across countries. And there are many ways we could capture this. We could look at what point countries would reach their pre-crisis level, the 2019 level. And by that measure, countries like China already got there even last year. The US as well is on that path, and at the same time we have the euro area, where we do not expect that benchmark to be reached until the first half of 2022. And even within the euro area, we have countries such as Germany and France expected to again reach the pre-crisis level of output in the first half of 2021, and others such as Spain much later, beyond 2022. Another benchmark, another way of looking at it is just to compare the per capita growth losses across types of countries, emerging markets, low-income countries, and advanced economies. And again, there what we see is that emerging and especially low-income countries have suffered the most. But I would say that what I'm showing here on this slide is yet a third way of looking at the recovery, which is just to take a look at where on current projections where we expect for countries to end up in 2024 compared to what we had expected prior to the crisis. So we're comparing the levels of GDP, which is one way of looking at scarring. So how much do we expect the crisis to affect those levels of output? And what you see here is a pattern is that for the world as a whole, that level of output is expected to be in 2024 is expected to be about 3% lower, but then with, again, tremendous variation across regions. Now, if you look at Latin America or emerging Asia, with excluding China, we're talking about numbers that are twice as large as the world level. And on the other end of the spectrum, if you look at the US, we actually have that level of output to be higher than it would have been without the crisis. And by the way, US and our current projections gets there in 2022. So in 2022, US is the only large economy where we expect the level of output to be higher compared to our projections prior to the crisis. Can I have the following slide, please? The other aspect of this divergence that we talk about is within countries. And again, we see the same pattern across the globe. This has been a very unequal recovery, and the crisis itself has hit different parts of the economy quite differently. Now, this zooms in on the labor market, but it's a broader theme. And again, what we see here is that the young, the lower skilled, and in some cases the women have been disproportionately affected by the crisis. And then if you look at the sectoral pattern of the impact, what is a curious feature and perhaps not surprising is that in some ways the crisis has accelerated some of the trends that we saw even prior to it. And it's in sectors that were more vulnerable to automation is where we've seen the largest job losses, whereas those that had been less vulnerable to automation, we've seen even some increase. And the chart in the middle is showing you that. And more generally, we do expect these trends to be accelerated, which does bode some trouble when it comes to, how do we get out of this crisis in terms of making sure that all of the groups that had been affected by it have a chance at having jobs, good jobs going forward. So we can come back to that if you'd like, Mark. Now, and I'll just end with my last slide, which is trying to present or to give you the bottom line of our report. I already talked about the outlook and the emerging divergences that we see as a major theme in this recovery. So perhaps just a few words in terms of our policy recommendations and the framing for that. Now, given the divergences and given how the crisis is playing out in different ways across countries, our message for this time, for this World Economic Outlook, has been about really tailoring the policy response to the stage of the crisis and the strength of the recovery, as well as the structural characteristics of the economy. Now, in all of this, I cannot emphasize enough the importance of international cooperation. But again, when it comes to the immediate response to the, what it would take to escape the crisis. So if a country is still in the midst of the pandemic, then prioritizing the health spending and providing well-targeted support is the way to go. Now, if countries are already getting out of it, and then of course the priority should be on safeguarding that recovery. and trying to minimize some of the scarring that I showed earlier. And then one could think of a third stage where it's really about investing in the future. And this is where some of the infrastructure and especially green infrastructure investment comes in, which of course would also help in terms of addressing climate change, as well as thinking about the legacy of the crisis and turning to issues such as debt sustainability and such, and having policy frameworks, improving policy frameworks in order to be able to achieve that. So the bottom line of all of this is that it's just the economy is recovering, but it's an incredibly long and hard road ahead, and there'll be many challenges ahead of us. I'll stop here.
Thank you for that wonderful presentation. Maybe we could turn to a few questions. The WEO projections always garner the majority of attention, but there are other chapters beyond chapter 1. There were 4 this time. Maybe we could focus on 2 and 3 for a second, and you could give us a brief overview. You already alluded to some potential challenges for labor force participation going forward, labor market scarring, etc. And maybe you can amplify a little bit, but will the technological change that is likely to be an outgrowth of overcoming the pandemic just result in the substitution of capital for labor? Is that embedded in your analysis and forecast?
Yes, thank you for the opportunity to talk about this, as we call them, analytical chapters. This time around, we tried to make them as closely linked to the outlook as possible. So chapter 2 was about scarring and prospects for scarring, and chapter 3 was about essentially the inequalities in labor markets and some of the themes that I already mentioned. So if I start with chapter 2 with scarring, as you can imagine, it's a tall order at this stage to be making predictions about what is going to be the level of scarring after this crisis that is really new to all of us. But we thought that this was a relevant policy question, and at least we should give it a shot and have kind of a prior based on everything that we could tell from the past and also from what we could tell from recent developments. And where we come out there is that there are good reasons why we should worry about scarring this time around. Especially when it comes to scarring in emerging markets as well as low-income countries. And what's in that sense, the patterns that we're observing so far do seem to be quite different from those in the after the GFC, which was a financial crisis. So the good news in all of this is that we do not have a financial crisis, and hopefully we will not have one in most countries. And what we know from history and from previous empirical evidence is that you get most scarring when you actually have those types of crises, financial crisis. Now, the other thing that also works another reason why one can be more positive this time around is just the enormity of the policy support that has been provided. But again, this holds much more for advanced economies than for emerging and low-income countries. And yet, going in the other direction is the fact that there's some aspects of what's transpired over the past year that could have long-lasting implications for human capital accumulation. I mean, just to put it bluntly, kids have, and not just kids, but the education aspect of this and how much has been missed over this past year, we will not know the impact of that for a while. And even in that aspect, there's a lot of variation across countries with, again, emerging markets and especially low-income countries being affected the most, where remote learning is not an option, and there's a real concern that some of these kids will just never go back to school. Now, the aspect of productivity is one which I would say is quite an interesting one, because of what you also mentioned, kind of the different forces working there. We could see a shift towards sectors that have higher productivity, which, other things equal, should increase productivity growth. Yet at the same time, we definitely have the challenge. We would have the challenge of reallocation. And I think this is where one other aspect of this crisis is that although credit growth has held up and it actually has done really well, there's a lot of policy support and measures that are kind of, once they were lifted, we could see a lot of bankruptcies, and making sure that all of that is worked out, and bankruptcy regimes work well and allow that reallocation would be an important point. So all in all, our baseline is for some scarring, with much more limited scarring in advanced economies than in emerging and developing economies, and also with countries that depend more on tourism sectors and service industries and such, expected to observe more scarring. So I'll stop here, but with that chapter. But as you can imagine, we'll be updating our priors as developments, as we have new information. And when it comes to the chapter on the labor market, what we see there and what we really focus on is on policies. What type of policies would help make that transition and would help people who had been affected the most during the crisis being able to have jobs? And we point out the fact that the job retention schemes that had been put in place in many, many countries have been quite successful, and the unemployment that we would have seen without them would have been really much higher. But at some point, it does make sense to kind of have hybrid schemes that essentially give incentives for reallocation as well. So the trick in terms of the policy support would be to kind of to roll back some of the job retention schemes without cliff effects, without making things really bad suddenly, while at the same time giving the incentives for reallocation. Because one thing that we do see in the data is that, if you were to switch jobs and if you were to do it through unemployment rather than still having a job, the cost of that for your lifetime earnings is much higher. So again, thinking about that in terms of the policy intervention makes sense. And again, thinking about reskilling, retooling, and active labor market policies, as hard as they are, should be an important part of the policy interventions going forward. I'll stop here.
Okay, well, thank you. Maybe you could tell us a bit about Chapter 4, because it really gets to the heart of a big debate in markets now about whether rising U.S. rates are going to cause instability in emerging markets and another taper tantrum. I have to say, as a former U.S. official that had to deal with currency war allegations and things of that nature, I like the theme of Chapter 4. It basically says that higher U.S. growth will boost interest rates, of course, but that the growth benefits outweigh the financing cost benefits. That's how I read it. Maybe I got it wrong. Some people say the fund's being Pollyannish. Any rise in U.S. rates is going to cause troubles. As a former U.S. official, I always thought that this type of global financial cycle analysis often focuses excessively on the U.S. There are a lot of different kinds of capital flow, FDI, and portfolio. Some countries are in good shape, others are not. Some float, others don't. There's push, there's pull factors, and I never thought that the debate differentiated enough among countries and talked too much about the Fed, although the Fed clearly impacts it. So maybe you could tell me more about Chapter 4, and do we need to differentiate more among countries, as well as better assess how capital flows are driven by all this diversity of factors, and maybe do we have too much emphasis on a global financial cycle, which in my view is code word for the Fed?
So the way I would characterize Chapter 4 in a sentence is that the headline would be that not all rate increases are created equal. I think this is, the source of why is it that rates are financing costs and rates are going up matters. And what we point out is that, which is something that we see in the data, is that if the source of the higher rates is improved growth prospects, then that has a relatively benign effect, and in some ways it actually benefits everyone. Now, if the source of the increase is a monetary surprise and again unexpected tightening, which comes with an adverse impact on the risk appetite and such, then that is a completely different story. And I think in that case, we would expect on average to see a negative impact on emerging markets. But the other part of the message is very much about differentiation. And we try to do as much as we can on this. And just to point out that, again, how close your trade links are with the U.S. matters a lot. So other things equal, if you have those high trade links, like if you are Mexico or Canada, chances are you would be the impact from the trade channel is going to outweigh the impact through the financing channel. Now, on the other end of the spectrum, if you're a country that has very high external financing needs, especially if they're short term, then the negative impact is likely to outweigh the positive one. Now, we spent, I would say, a third to half of the chapter also looking at what emerging markets have been doing during this crisis. And as you know, many of them have implemented asset purchase programs. And to many of us, this was actually quite a surprise in terms of how much space these economies have had to have these sorts of interventions. And again, this is where we see the differentiation, that countries that have good frameworks, and not just monetary frameworks, but also fiscal frameworks, in a way we expect to also have a higher degree of monetary independence. And of course, the exchange rate regime matters, and all of the type of things that you mentioned also make a difference. So I would characterize our view on this issue of how much space, how much monetary independence do emerging markets have, as a fairly nuanced one. And I'll stop here.
Well, great. You mentioned the word sustainability. I think the fund and others have long focused on a debt to GDP ratio as a rough, imperfect indicator of thinking about sustainability. Obviously, sustainability depends on the future, and one never knows what that's all about. But for example, speed bumps, the 60% Maastricht criteria was something the fund, the Europe department certainly supported. But it was developed at a time of significant positive real interest rates. Real interest rates are negative now. They've been declining. Debt service costs are often well down despite high debt stocks. That's the case in the US. The fund is urging that fiscal support be sustained during the pandemic, but has the pandemic taught us that advanced economies, maybe even emerging markets, have more fiscal space than previously thought? And is the fund relaxed about that, or is the fund thinking that we need to quickly get back to consolidation when the pandemic ends while avoiding fiscal cliffs? I mean, how do you see that for advanced economies and emerging markets?
Okay, so my first reaction would be to say that even prior to the crisis, I think we have moved away from these simple benchmarks, numerical numbers. And we had worked for a number of years on this, operationalizing this concept of fiscal space, and devoted a lot of resources in terms of trying to quantify that and apply it across countries by having a framework of what that fiscal space is, but then allowing for factors that may vary over time, including borrowing costs, as well as the variability of shocks and country-specific characteristics. So in the current environment, and by the way, I should also, since you mentioned the Maastricht, the SGP rules more generally, I think we'd welcome the escape clauses that had been activated in Europe, and also we very much are looking forward to the revisit of the whole framework that for a number of years, the SGP framework that we had been calling for an overhaul, also in light of just its complexity and just thinking about also the new world and what it would be. So I'll set that aside, and I'll come back to the issue more broadly of our fiscal advice in the current environment. So at the very beginning of the crisis, our message was spend in order to really address the health needs and such. And then I would say months ago, at the start of the year, we were warning about premature withdrawal of fiscal stimulus, which we saw as a risk. Our message now is that is to have the fiscal support, but to have it really in a targeted way. If we're still in the midst of the crisis, or now we are in the stage of safeguarding the recovery, because the type of fiscal needs, demands that are going to be there for a while, and so using that fiscal space, I would say judiciously would be quite important. So what that means in practice would be different across countries. But at the same time, we also see this, it's not, while borrowing costs have declined and they're still, or even though they've risen a bit lately, they're still quite favorable. The issue of having a credible medium-term framework and having a plan of how you would get back to lower levels of debt is important. So thinking about that now and not leaving it for later just seems like a very sensible thing to do. So that's our message. Again, I would say it's quite nuanced, but if I were to characterize it in one word, it would be, really the emphasis is on being targeted.
Thank you for that. Just another quick question and outlook for inflation, and of course that gets you into monetary policy and interest rates. And if I can throw a curveball into that, you have the Summers and Blanchard fretting that U.S. stimulus is much greater than the output gap and could cause demand pull inflation. Goodard and Pradhan are suggesting the great moderation may be coming to an end because of the global demographic changes. And they seem to think that the base case inflation outlook is too sanguine. And meanwhile, the Fed seems to think an upturn in inflation will be transitory due to base effects and supply constraints. And of course, that there's plenty of slack and inflation expectations are well anchored by a credible central bank. So does the fund have any thoughts on this outlook and debate?
We take a position on this in our World Economic Outlook when it comes to talking about the inflation forecasts. And our take on this is that in the baseline, we do not see rampant inflationary pressures. What we see instead, if we look at measures of trimmed means or weighted median inflation, is that if anything, we actually have declining inflationary pressures. Again, we're talking about underlying inflation. Now, that is not to say that we are not going to see increases on a transitory basis in headline inflation. But I think the key to that is that, again, we expect that to be transitory, and we expect that to be handled appropriately by central banks. Now, the underpinning this call, I think, is also the idea that the Phillips curve is still, in our view, it remains quite flat, and some of the structural reasons for low inflation that we had prior to the crisis, we still expect to be in play going forward. So, for instance, the somewhat limited wage bargaining power, the forces of globalization, the market power of firms, and all of these things, we think that they're going to still work in the direction of keeping inflation low. And perhaps the most important reason you already mentioned is the credibility of the frameworks that are being deployed, that are being used across the world. And I think a simple way that I think about this is that, in countries where you have fiscal dominance and where it's clear that rates are being kept low because of fiscal pressures, you have inflation. And in countries where you have monetary dominance, where the central banks have independence and they are credible, then you do not have that inflation issue. So to the extent that we still live in this world, which we think we will, then again, we do not see inflation as being a huge problem. Now, are there risks around it? Absolutely, and this is why policymaking is going to be very challenging in the years ahead.
Well, let me throw a last question at you while the audience submits questions in the chat function. We're looking to have healthy audience questions, so audience, let loose with the questions. In the meantime, external positions, exchange rates go to the heart of the fund's mandate. The U.S. fiscal deficit stimulus is quite aggressive. It's going to cause, according to some estimates, the current account deficit to surge towards 3.5% or 4%. It's been hovering around slightly above 2% for a long time with the advent of fracking. Some surpluses are enormous. Germany, Asia may become even more enormous. Debates about global imbalances and exchange rates have been somewhat muted in recent years. Is the fund worried about a resurfacing of these debates and possible protectionism alongside that? And what advice do you have to offer on this front?
Okay, so we do see in our baseline forecast a significant widening of the U.S. Current account deficit. And just to be precise, it was 2.2 in 2019, and we're expecting it to be 3.9 this year. Now, the counterpart of that, as you pointed out, has been an increase in surpluses, and part of that is the demand for pandemic-related spending, but then another part is also durable goods and so on. So we did see an increase in imbalances in 2020, and we are expecting a further widening of those global imbalances in 2021. Now, over the medium term, what we have in our baseline is a gradual narrowing of those imbalances. But to the extent that we do not see that, and these imbalances persist, I think you are right that this could fuel trade tensions, and could be a target for protectionist measures. But even more broadly, it could also cause a disruptive exchange rate movements and such, which is what we do not want. So what to do about it, and what is our advice? Well, our external sector report is the main product, the main thing that we use in order to put the whole picture together and to think about global imbalances and policies. And there, the recommendations are again in the direction of fostering that external rebalancing. And what that means for the surplus countries is having fiscal spending, especially infrastructure spending, where that is needed in some countries. In others, the issue is more creating the safety nets in order to prevent excessive private, basically where there is too much caution in spending. And I think that is one part of the story. And when it comes to the countries with excessive deficits, then at some point also thinking about the path of fiscal consolidation would clearly be an important aspect. So just to sum it up, I would say it is very much on our radar, and we are going to be coming back to this issue in the coming months and years, I would say.
Well, great. Well, let me carry on. You alluded a little bit to job retention schemes and how to deal with them. There is a bit of a transatlantic debate about the nature of labor support. There's an argument that Europeans have provided support to firms to keep their workers on the books, whereas in the US, we provided unemployment support and compensation, but we're much more tolerant. So there is this debate between the US and Europe, and that the US approach is better for labor mobility and readjustment in the job market. Do you have a view on that?
I think what we have seen is, as you said, there have been somewhat different policy responses, but by and large, I would say the job retention schemes have been much more prevalent this time around than in any previous crisis. I mean, I'm just thinking back to the global financial crisis, where Germany was one of the few countries that had the Kurzarbeit scheme, and now, those types of schemes were used not just in Europe, but I would say across the world. And I think there was a logic to it in terms of kind of trying to preserve the match between the workers and the firms. If you think that what we're seeing is just really a transitory shock. Now, so I would say that given the existing labor market characteristics of these economies, that type of response, I would say, makes sense. Now, as the crisis gets longer, there's a question, of course, of affordability, and there's also an issue of how they're tapered. And again, to the extent that there will be some need for reallocation, how to move to that reallocation mode. But I guess my bottom line is that I don't think there's a right or wrong answer here, and I think looking into the specifics of the country would make a big difference, including the fiscal space, which is how many resources are available for those schemes. And just one last thought is that in other countries, especially in some emerging markets, it's really the cash transfers that had turned out to be the most effective way, where you have very large informal sectors and such, which is another example of gearing the policy response to the specificities of the economies.
Well, thank you for that. I have gone through my formal questions.